deferred tax can either arise through permanent difference or temporary difference. You can have what we call deferral method. We can have liability method. If it's liability method, you can have balance sheet liability method or income statement liability method. If it's balance sheet liability method, you can have what we call taxable temporary difference or deductible temporary difference. Taxable temporary difference gives rise to deferred tax liability. Deductible temporary difference gives rise to deferred tax asset. Now, I will explain this. This is taxable temporary difference. That is deductible temporary difference. Taxable temporary difference gives rise to deferred tax liability. Deductible temporary difference gives rise to deferred tax assets. Deferred tax constitutes an issue. Why? Because the way accounting principles treat transaction is different from the way tax laws treat transaction. That's all. Assuming financial statements are prepared based on tax laws, then there won't be reason for deferred tax. Or assuming the tax laws or the taxman, the tax authority, appraises companies based on accounting principles, then there's no reason for deferred tax. So deferred tax arises because of the differences in treatment between accounting principles and tax laws. Full stop. Meaning there are differences. And those differences often arise because transactions are included in the financial statement in the books of accounts this year, but will be included for the purposes of tax computation next year or upper year. That's the problem. Now, these differences can either be permanent or temporary. It is temporary if, yes, the accountant has treated it this way this year, but the taxman has not treated it. But next year, the taxman will do the same that the accountant did last year. That means it's temporary. For instance, you have incurred pension costs, expense. The accountant will debit profit or loss. But the taxman might ask, have you paid it? You've not paid it. My friend had it back. Because by reducing profit by pension, you are indirectly reducing your tax liability. The taxman may say, hey, when you pay it, come back, I will give you the relief. That means what you have done in this year's account that the taxman has refused, by the time you pay it next year, the taxman will do the same thing. So meaning the request of adding the pensions back is a temporary difference. Some differences are permanent.